Great.
Sure.
All right, let's get rolling, guys. This should be really fun. I'll start out by saying that this webinar presentation contains general information only, and Grant Thornton LLP is not by means of this presentation rendering accounting, business, financial, investment, legal, tax, or other professional advice or services. Bitwave is not by means of this presentation committed to delivering a specific feature or functionality. It should not be relied upon in making purchasing decisions. The development, release, and timing of these features or any functionality remains in the sole discretion of Bitwave. This presentation is not a substitute for professional advice or services, nor should be used as a basis for any decision or action that may affect your business. Before making a decision or taking any action that may affect your business, you consult a qualified professional or advisor. The views and opinions expressed herein are the views and opinions of the presenters and do not reflect those of Grant Thornton LLP or Bitwave. I think I might have a future in TV, drug commercial, quick talking sort of thing. Everyone, my name is Pat Wyatt. I'm the CEO of Bitwave. I'm sure y'all know me. Bitwave is the world's first enterprise-focused digital asset accounting and tax solution out there. We focus on only sort of the hardest problems for businesses using digital assets, and we love working with all businesses that are using digital assets. It's a fun part of our life. With me today, first of all and foremost, my esteemed colleague, William Wright. William, would you like to introduce yourself?
Sure. So I've been with Bitwave since the end of last year. I am a consultant on our solutions team, help with implementations of Bitwave for enterprise clients. My background is as a CPA, had time as an auditor, worked as a regulator, and really help focus our clients' efforts on trying to implement Bitwave as quickly as possible and get them up and running with the software so they can do their accounting.
Perfect. William, thank you for joining us. I don't know, did you mention William, you're a CPA. So we have two CPAs and also tax something, right?
Yeah, so I'm a CPA as well as Mark. I'm a member of the AICPA. Again, about 10 years experience within financial services, and last couple of years have been in crypto space.
Perfect. Mark, great to have you on here today. How you doing, man? Please introduce yourself.
Doing well. Well, good afternoon to everyone. As Patrick mentioned, I'm Mark Lee. I'm an audit partner at Grant Thornton, and also lead the Grant Thornton's West Region Blockchain Digital Asset. So, but we do have a national initiative in blockchain digital asset. With that said, I have over 20 plus years of experience in public accounting, as well as private industry. I am based in San Francisco. I think I've been in this space since 2014, and been working with blockchain digital asset companies, across different, different pillars, the exchanges, the custodians, the investment funds, and so on and so on. It seems like I've been in this industry for so long, but 2014 is about 8 years, but the industry is still maturing and it's still in its early infancy, in my view. So it's got still a lot to go, but excited to continue to be in this space. In addition to blockchain digital assets, I also work with fintech, technology, and financial services companies. That's kind of my background before blockchain digital asset experience. And then last but not least, I am also an adjunct accounting professor at the San Francisco State University. So I love teaching our future leaders and about accounting and auditing. So it's if you'd love to be a guest speaker someday in my class, let me know. I might charge a fee for those people, but no, just kidding. But
I didn't know you're an adjunct professor. That's so fun. You teach crypto accounting in your class?
I may do that. I may do a little crypto or influence crypto students.
Sign me up for that guest speaker spot, man. That's really fun. I didn't realize that.
Yeah,
and it's funny. 2014 sounds like forever ago, because it's 8 years, but yeah, I still think of crypto in general as such a nascent young industry. But we do have to remember that crypto first Bitcoin transaction was 2009, and that was 13 years ago. Like the long time that this has been a major part of a lot of our lives. Like I got into crypto about 2010, and it's pretty crazy to think about that here. Well, wonderful. Thank you guys. Welcome today. High level agenda. This should be pretty fun. Like we're doing this as a fireside chat. So I'm going to be asking Mark and Will questions. I'm going to start out with a little bit of a description of kind of like how we got here. So I'll start out with sort of a where we are today over the last, we just said 13 years of the evolution here. And then I'm gonna spend a lot of time just chit-chatting with Mark and William here on kind of what's been happening, what are the new progressions today. First things that I'll mention here. So think about the evolution of this. The first Bitcoin transaction was 2009, and when that happened, no one was deeply thinking about the accounting or tax implications of crypto. The people working on it back then, and I was lucky enough to be working on it at sort of similar times. I have some code contributed to the Bitcoin Core node. This was not really yet a, hey, we're going to rewrite the financial system. It was this, idea of a store of value, and can you find money that is separate from government, government issued fiat. That was sort of very, very ideological driven in the early days. You sort of fast forward a few years, over time, crypto started getting more and more general interest. So, through 2014, so Ethereum, there were always like little coins that came out. I know it might be hard to believe, but because today there's, I think in Bitwave, we track something like 25 million tokens, maybe more than that, like an incredible number of tokens. But even in the early days, there actually were a lot of forks of Bitcoin early on. Ethereum didn't really come out until 2015. So there was this period when it really was just sort of Bitcoin was the main cryptocurrency out there. And it was 2014 that sort of the first ever accounting guidance came out around crypto in general. And it wasn't really guidance as you would traditionally think of it, because this wasn't FASB, this wasn't the IRS. The IRS had a couple of memos that they dropped in between point A and point B, just sort of saying, yes, treat this as property. But the Big Four got together and drafted a memo. It was non-binding, just a kind of a best effort memo. And essentially, when they went through and did their analysis, when you basically do an analysis of where a particular asset should go in your balance sheet. They started popping down the list. They started at cash. Like, is Bitcoin cash? No, Bitcoin's not cash. No one's really arguing that Bitcoin is cash. Now, today we have a really fun argument of, are stable coins cash, which is going to be obviously something we talk about today a little bit. But back in the day, no one was saying that Bitcoin was a cash equivalent. Is it a tangible asset? Like, can I drive it to my work site? Can I use it to put up a wall? Like, is it something physical that I can pick up? Obviously, it's not a tangible asset. And it did tend, at the point, didn't go, a lot of the other qualifiers for tangible assets didn't get qualified either, right? Because it wasn't used for it wasn't goods and services use and things like that. So when the Big Four kind of originally went through it, they ended up popping down the list and they ended up on intangible long-lived asset, which I always sort of joke around that, like, the main intangible asset that accountants and bookkeepers deal with on a day-to-day basis is goodwill from acquisitions, things like that, and then domain names. I mean, there's just not a lot of intangible assets that you sit on out there. And that ends up being really funny because the treatment for intangible assets, of course, an impairment model under US GAAP. So you end up having this situation where, when we come across folks that are new to the space, 80% of them have never run impairment before, because we've never impaired our domain name. The last domain name probably get impaired was Enron.com, although I think FTX is probably going to get, they probably have to do a little bit of impairment on their domain name here as well. But it still is a 3-letter domain name, which is pretty good. So I don't know. So when they ran through, they wrote this memo, they came up with this assessment. This is an intangible asset. And I think it's fair to say that essentially that has led to an incredible amount of work, effort, headache, long nights, discussion between everybody on this call and probably everyone listening to it if you have to do impairment, because impairment was never designed for a asset that had high liquidity and was traded on a daily basis in 2,000 exchanges around the world. And so today, where we are today, that's kind of how we got to where we are. That's how we got to this default treatment. Every day there is debate about that. I don't mean at FASB, I mean, like, every day that I'm on a call with one of our customers, like, Pat, like, do we really need to do impairment? Like, yeah, I know it's kind of a weird treatment, but this is the way that we've sort of decided to do it. And it looks like there might be some changes to that coming. That's a big part of our discussion today. So that's how we got here. What I'm going to do is let's start out with Mark. Given what I just said, so fill us in on kind of a quick summary of the recent FASB meetings and the crypto projects per se that they've been doing in 2022 here.
Sure, Patrick. Happy to do that. So I'll try to stay high level, and I know we're going to get into a little bit more detail on some of the projects and guidance that might have come out. But I think it's really important to note that we've made progress as an industry, both from accounting standards or guidance standpoint. So we have to give credit to the FASB and the standard setter that we're definitely making progress. It may not be at the speed as everyone wish to have, but we are making progress in that sense. So keep that in mind. But just a quick summary, right? And then for those on the phone that may not have kept up with the FASB, back in May 2022, I think it's, the board decided to put the accounting for and disclosure of certain digital asset on its list of project, which is a great starting point. I think that got the train going. So I think that's really very appreciative and forward looking there. And then jumping forward to August 22, right, the board decided, that's defined what is within the scope of digital assets, and, listed 5 criteria that need to be met for it to be a digital to be a crypto asset, then therefore under the scope of the guidance that they're going to come out with. And then I think the 2 important meetings that in 2022 that brought additional light to the clarification of guidance per se, if you want to call it, is in October 2022. I think the board introduced the fair value concept with using topic 820, which I'm sure William's going to get into a little bit more, but I won't steal his thunder per se. But that's a good milestone, right? And then in December of 2022, the board provided additional guidance in addition to the fair value concept relating to how crypto asset or certain crypto assets should be accounted for, and therefore, as well as how it should be presented on the financial statement, along with the additional disclosure requirements. So I think that milestone, that progression is really important because it shows that we're making progress, and the standard setters are listening as well. And think that's just want to do a shout out for them, because it's important that we recognize that as well.
Oh yeah,
so that's kind of a quick summary, Patrick. So back to you.
It's really true. I mean, because if we really think about, like, the explosion of crypto happened in 2015, 2016, 2017. So for FASB to turn around within that time period, which is, let's say, 5-6 years, is actually pretty impressive. Like, that was, some of the things that's taken a lot longer than that for a lot of the other standards that we rely on every single day. So to actually start to appreciate this and look at it seriously after just 5 or 6 years is actually moving pretty quickly there. So, William, okay. So with respect to the 2022 meeting, the October 2022 meeting, where they started to bring this up, can you discuss the FASB conclusion on how they're thinking about, conclusion is maybe not the right word, but like where their current thinking is on how to account for crypto and digital assets?
Sure. When we started to discuss, having this meeting today, one of the things that I wanted to highlight is, the FASB, when they kicked off this process, had what's called an invitation to comment, which is essentially an ability for the industry and practitioners to comment on what they would like to see in the accounting guidance. And in there are about 500 different responses that the FASB collected, and over 80% of them noted some type of fair value measurement for crypto assets. So where we are today is kind of the culmination of having some of that industry outreach, the FASB doing some research on the topic and seeing how it impacts various practitioners. And in the last quarter really of 2022, having some decisions made in regards to how fair value measurement would work for crypto assets. In regards, and Mark already hit on this a little bit, In regards to the crypto assets that the FASB has discussed utilizing a fair value measurement, there is a clear scope for those digital assets. So not all crypto assets are going to be part of any new guidance that comes out. The definition is broad, but there are some areas that likely would be scoped out. And I'll highlight really quickly, the crypto assets have to meet the definition of intangible asset, which is very straightforward. Those are assets that lack physical substance. So Pat already had mentioned, a goodwill is a intangible asset, domain names, things of that nature. Almost every crypto asset I can think of falls within that criteria. The rest of the criteria are, again, pretty broad but straightforward. That the crypto asset, the holder of that asset does not have an enforceable right or claim to underlying good or service, that the digital asset is held or resides on a blockchain distributed ledger, secured by cryptography, and the last one is fungible. So that last piece would indicate that digital assets potentially outside of the scope of any final rule would likely be NFTs, right? Non-fungible tokens. I'd like to highlight that because I think when we talk about the crypto space, as Pat already mentioned, there are 25 million tokens that we in some way track or index in Bitwave. The broad, scope of this guidance that will come out will pretty much encapsulate a vast majority of the more utilized tokens that we're all aware of. But there will be tokens such as NFTs that may fall outside of the scope. In regards to the measurement of crypto assets at fair value, as Mark already mentioned, they're going to be held at fair value under any new guidance, and they're going to be measured we're going to have increases and decreases in the gains and losses, unrealized gains and losses of the crypto assets. So what that means is at the point of acquisition of a digital asset, you're going to record it on your books as you would today at cost. And then at each reporting period, any unrealized gains or losses, you're going to record in your income statement and then mark up or down on the balance sheet the crypto assets. One of the areas that was discussed was, would this guidance apply to every single practitioner user of digital assets, every type of entity that was recording digital assets on their books, private, public, et cetera? And the guidance was, it was determined by the FASB, and the guidance is going to apply to all entities. So if you're a private company, if you're a public company, there's certain industries, healthcare, entertainment, investment companies, they're all going to be subject to this guidance, which is provides a consistency across all the various entities that may have crypto assets on their balance sheet. In regards to expenses, there's some diversity in practice, and the FASB determined that in general, expenses would be hitting your P&L, right? So if you have a commission, you should expense that as incurred. Some industry guidance may lead to capitalization. So, there is specific guidance out there that requires you to capitalize certain costs. You should still follow that guidance. But in general, if you were to go to exchange and they charge you a commission, it should be an expense. I think that covers most of the points. I don't know, Mark or Pat, if you had any questions or items you'd like to add on measurement.
Well, I was going to pull this up because we got a question about this in particular. It is really interesting. So this you rattled off this list really quickly, but one of the items on this list, this is a blog post we did. If you go to bitwave.io/blog, you can find it. That this covered exactly what was released in that first October, what they actually released from the minutes of that particular meeting. And this is one of the pieces that they use as a carve out, besides the intangible asset and the other NFTs, was did not provide the asset holder with enforceable rights or claims to underlying goods, services, or assets. This to me was always one of the squishiest parts of this particular memo that got released, because it's really, if you like Bitcoin and Ethereum very obviously don't really have underlying rights. But and then there's some things that like really obviously do. So, Roofstock, a couple months ago, they sold an NFT online that when you bought that NFT, you got rights to own a house. So there is obviously an underlying right that comes along with it. But then with the gray area on this one would be something like a Uniswap governance token. So the Uniswap governance token, it gives you an underlying right to vote within their governance body, but it's not really like an underlying right to goods or services in the traditional sense of it. I don't know, William or Mark, do you guys have any thoughts on how this is going to shake out, like as we get towards a clearer definition getting handed out? Any thoughts on how this will shake out?
Well, Patrick, let me maybe just one more comment to your point, and just to clarify, right? I think we use the word crypto assets, digital assets, cryptocurrency sometimes interchangeably, and really without giving any thought. So just wanted to make sure that the listeners understand that. I think the word that's used in the guidance throughout the FASB meetings and other SEC conferences is crypto assets. So we should just keep in mind that what we're talking here is crypto assets with respect to this webinar, which may not cover, all other cryptocurrencies or digital assets that all of us might be, thinking of. So, and I think, as we said at the very beginning, I think it's important that as you listen to what we have this webinar, but also consult with your professional advisors, because we're not going to cover every single rules and every exceptions to the rules, if not. But it's really for us to just acknowledge that maybe we have to be careful how we use the words, but crypto asset is really what we're getting at. So I just wanted to add that, Pat, just to put some clarification in for folks.
Perfect. So then another question that we got here is, would NFTs remain within the scope of intangible assets, i.e. would have impairment, and impairment can't be reversed once impaired? Either one want to opine on if the reading of the way it looks right now carves out NFTs very particularly from fair value?
I don't know the answer, Patrick, because it's definitely not covered. So it's going to be case by case, and you would have to, talk to your, advisor, as I said before. Just have to look at what is defined within the scope of what FASB had, at least in their meetings, have communicated, and those are the 5 criteria that William read out, and Patrick, you showed on the screen. But yeah, it's hard to say. I mean, I wouldn't be able to conclude that.
Yep. So okay, so Mark, all right, so we kind of got through how we're defining a crypto asset in this case. Let's step back slightly and say, not just in terms of the fair value income statement impact, but with respects to the presentation disclosures within financial statements. Can you share some insights into how FASB is thinking about this for crypto assets based on their what they've released? Sure.
No, I think I appreciate that. So with respect to presentation disclosure, first of all, as we've been talking about, these are FASB's meetings and what their conclusions are. The former guidance is going to come through this coming year with initial, exposure draft. So just know that. So what we're talking about is what's been discussed in the meetings. So first of all, to recognize that the presentation disclosure requirements, as William alluded to earlier, does apply to both public and private companies. So on an annual basis, you would have to follow that. More importantly, for public companies, you would have to consider the interim basis. So any quarterly requirements that you would need to do as well. So just keep that in mind. And then second point, before I get into the presentation requirement, second point, that investment companies, if your investment companies subject to 946 or not-for-profit entities subject to 958, you will continue to follow that presentation, except you will be subject to some minor or whatever conforming amendments that need to get amended to reflect this conclusion that the FASB have reached. So just keep that in mind. With all that said, the presentation requirements, there's a few here on the balance sheet. I think William talked briefly about it, is that, any crypto assets, or at least crypto assets, as if they meet the scope definition, would be presented separately from other intangible assets. So that's one note to make. And on the income statement, all the gains and losses on crypto assets would be recorded in net income for each period, and as well as presented separately from other intangible assets with respect to other changes and other impairment charges relating to those other intangible assets. So basically, the point is, on the balance sheet income statement, you have separation of the two types. On the cash flow statement, not much guidance out there other than, ASC 230 will continue to apply, and you would just look to that as analogous to the rules. Except, they did come out to say that cash flow from or cash flow received from the sale immediately or almost immediately after you acquired the crypto assets, as you receive them, you would record that or classify as cash flow from operations. So basically, there's something to think about, but not much on a cash flow statement. I think you continue to follow what you've been used to, which is ASC 230. And then from a disclosure standpoint, I think that disclosure is really where you might have a lot of work to do. I think first and foremost, from a disclosure requirement standpoint, it says that you should follow ASC 820, which is for fair value measurement. So you may want to take a look at what ASC 820 says and kind of go through the literature there. But additionally, at each reporting period, you're supposed to show each significant holdings of your crypto assets. So Bitcoin, Ethereum, Litecoin, you would have to show each of those holdings along with the number of units held, the cost basis, and the fair value of each of those holdings. Okay, so if you think about that sentence, that just looks like your typical, fair value 820 disclosure for investment companies, where you have to lay out, all the significant investment positions greater than, 5-10%, whatever those rules that you used to. So it just looks like that. So it's very similar to that. In addition, you have to show a roll forward of your crypto holdings. So showing starting with your beginning balance, showing your additions, disposals, gains and losses, and also for any additions to your roll forward, we have to disclose whether or not how they arrived or how they're earned. In other words, did you buy them, mine them, stake them? How were these additions come in? So it's important to disclose the nature of these additions as well in your roll forward. And then two other things: for any assets or crypto assets disposed during the year, this is where I think a lot of work might need to be considered here. You would have to show the cumulative realized gains and losses on a gross up basis rather than a net basis. So it's really, here I think the level of work would require that you have to track each transaction by transaction, or somehow you would need to know the gross amount of each transactions coming through in order to get to the cumulative realized gains and loss. So a lot of work there. And then one other point is that you have to disclose the fair value of any crypto assets that are subject to restrictions, so any restrictions to these crypto assets, the nature of it, and then the remaining duration of that restriction, as well as what conditions must be met to remove the restriction or restrictions. So those are some of the additional disclosure that was discussed in the December meeting. It's definitely definitely a lot of work, but that's what's being put out. So I'll turn it back to you, Patrick. But
yeah, and I won't toot our own horn too much, but if you are looking for a solution that has a cost basis roll forward with transaction level reporting for gains and losses. We got a thing for that at Bitwave. That's what we do. And we actually just launched our roll forward not too long ago, because it's a complicated kind of structure to be able to do it on a transaction by transaction basis. But it's a really cool report, and it's really interesting. So great. So we did get a couple of questions here, which I think directly relate to the fair value. One was any comment on where these crypto assets would fall in leveling category? I think that's a pretty technical question. So maybe you could explain the question if it makes sense, and then maybe if it's possible to answer it.
I can start. I think that the one clear piece of information that came out in regards to the application of fair value is it would fall under ASC 820. So the same principles would apply to how you would level those assets, whether it's level 1, level 2, level 3. We look at the observable inputs. We see a variety of considerations that companies go through when looking at pricing, whether it's principal market considerations, how actively their crypto assets trade. So I would say that in general, the guidance that we've seen so far looks that you would apply the same rules under ASC 820 as you would today in regards to fair value. And I wouldn't anticipate there'd be any changes to that. I don't know, Mark, if you have anything to add there.
Yeah, no, William, I think you're right. I mean, I think for leveling, you first go to 820 because that's what's being told. That's what you should be using to start with, and then from there it's going to be based on facts and circumstances and what makes sense to deviate from it, right? So I think that's your starting point, is 820. So I don't think there's any additional comments I can add into that. So I agree with you.
Good. So I think I mean, speaking personally, I'm really excited about this because when I look at the world, I tend to think about what's going to get more people using crypto. And in particular for Bitwave, we tend to think what's going to get more businesses and enterprises using crypto. And getting rid of the intangible asset treatment, getting rid of impairment is something that will make crypto digital assets much more palatable for a lot of public company CFOs and things like that. I mean, if you are really worried about your a P&L hit from just holding a particular asset, and that's not acceptable for you if you have quarterly reporting, it really changes the way you think about digital assets. So I think it's really great, personally speaking, as myself and Bitwave, that we got this this guidance. But what do you guys think? So what are some of the benefits? And I'll say, Mark, maybe you first. What are some of the benefits and what are some of the challenges that we're going to see from this?
Yeah, no, I mean, I think the benefit is, first, as I said at the very beginning, it's good that directionally, we're getting more guidance. I think the industry is getting the attention, FASB and the regulators and other, standard setters are thinking about it. I think that's the, one of the benefits of having that. Having these additional guidance, does help the industry and helps practitioner as well as investors in understanding this, getting all the proper disclosure information to be able to make sound investments and make decisions. I think the more, the merrier. I'm always big on disclosing and providing as much as you can that is, transparent on the financial to the reader, the financial statements. Transparency, can't be overemphasized at all, right? I mean, you need transparency. You need to make sure that readers of the financial statements are able to, by reading the financials, understand exactly what happened in the company. Short of being an employee of the company, you know exactly what happened in the company, what transaction had transpired. I think so. Providing these additional guidance, helps move the industry forward. It makes at least some consistency in terms of what is needed in the financial statement, right? So I like it, and I hope that more will be forthcoming as we get through this process. And so that's to me the biggest benefit of it. I mean, I'm sure there's a lot more, but just from a global perspective and from an industry perspective, this is a big step.
William, how about you take the other side of the question, which was what sort of challenges do you think we're gonna see from this?
I think, any change in regards to accounting for really an asset class, right? It's going to come with additional costs and also challenges in regards to bookkeeping, record keeping practices. We've talked today a little bit about our solution, Bitwave, but in general, the industry needs software to account for crypto assets. And the consistency that this new guidance would bring is great because it will apply to both private and public companies and hopefully lead to a standardization in regards to the bookkeeping, record keeping, financial reporting practices of our industry, because there's just a tremendous diversity out there depending upon the size of the company, the types of products that the company offers, use cases for crypto assets. So for me, it definitely will come with some pain, but it will ultimately lead to some of the consistency we see in more mature industries, specifically financial services.
Yeah. So this it leads to sort of the next question here, and we also got this question in the Q&A here, which is, will this have implications for 2022 reporting, or will this have to be prepared for 2023? Will we have to prepare these disclosure documents for last year, or will that be for 2023? I don't know if there's anything we can kind of share around that, because obviously we don't have any special knowledge. This is all kind of hypothesizing.
Yeah. The way I interpret this, right, is, and being in this for many years, until the FASB conclude and issue the standard, it's not formal guidance yet, right? This is the conclusion that they've reached at a meeting for which they will then start drafting the rules. So I think until the rules are set and the final set of rules are issued, I don't believe that you would apply immediately. And that's just my view of how I understand things should work. So I think currently you apply what you currently been doing is my understanding.
Yeah. I think we talked about this. Oh, go ahead, William.
No, I was just going to say, one of the comments they've made is exposure draft has not been released yet. That is, kind of the key document, right, to give us some light on how implementation will go, and whether it be retrospective, prospective. As of right now, we're applying the rules, cost plus impairment. But hopefully, once the exposure draft comes out, there'll be some discussion around how it will impact implementation and key dates.
Yeah, and that will be the big. I mean, essentially, one of the big items that will come out will be prospective versus retrospective, because that would make a very big difference if you are doing a restatement, or if you are just sort of if you are changing your forward-looking statements. And of course, there's a really interesting side effect that I tend to think about, which is we have customers who've had to take very large impairment expenses, and there is going to be this point where you're going from an impairment model to a fair value model that you may end up picking up a very large, income statement gain to recover from your impairment loss. So, I'm sure a lot of this will come out from the guidance, but it's probably things to start thinking about now is like, how does that impact your business if you actually do have to take pick up an item like that on your sheet? So interesting questions all around. I want to sort of, we're going to change tack here just a little bit. We're going to leave a little bit of time at the end. So if we've gotten some great questions, keep on dropping questions into the Q&A here. I noticed one person with their hand up in the audience. I can't really call on you because we don't have that piece set up, but if you want to drop your question in the Q&A, please feel free to do that there. But we're going to switch tack just very briefly here to talk a little bit about some of the new recent SEC news, because the SEC has been real active over the last few months here, and probably even more so with FTX and all of that stuff here. So Mark, at the recent 2022 AACPA and SIMA conference on SEC and PCAOB developments in DC, there were a few really important highlights. And I know we're always and PCAOB is a very interesting topic now into itself after all of the audit news and everything that's been coming up around there. Could you share, either you guys, could you share some of the thoughts on some of the key decisions and developments that came out of that?
Sure.
Sure.
William, you want to go first? Go ahead.
Yeah, sure. I'll go first. I can cover some of the comments there. So the conference happened almost a month ago, middle of December, and there were some speeches that covered from the SEC topics in regards to crypto asset lending consultation that was performed, where the staff did not object to a lender derecognizing a crypto asset, but said transfer control of that asset to the borrower. This is an interesting use case. I don't know how many folks out there listening are lenders or in a lending relationship in regards to crypto assets, but it was a situation in which the staff reviewed with this consultation lending agreement. It came to the determination that due to the term of the loan and the way in which the loan was transferred back to the borrower, that there was no longer an economic benefit to the specific crypto asset subject to the lending agreement. That's a jumble way of saying that the lender did not have rights to that crypto asset. The SEC staff then came to the determination that the lender should record a loan receivable at fair value and mark to market that loan at each reporting period, with gains and losses recorded in the income statement. This was an interesting topic. Again, it's very specific to those who may be in industry simply, with lending going on, but it was one of the topics that was covered in his speech by the SEC staff. Mark, I don't know if you want to cover the discussion of the bankruptcies, but more than happy to hand that over to you.
Yeah. I mean, I would just, thanks, William, on the SEC front. I would just say that more that comment around, the SEC's division of Corp Fin, which most of you know, it's the corporation finance. I think it's on December 2nd, if my dates is right, December 2nd, 2022. They had released a sample letter, and just so that folks that are in public company or working with public companies or work for public companies, you want, and dabble in crypto, you probably want to look at this sample letter. But basically, Corp Fin released a sample letter illustrating comments that they might issue to companies. So the key word is might, right? I mean, they provided a sample letter for folks that works in public companies to look at the sample letters that they might send to your company CFO about some direct or indirect exposure to some of the most recent crypto asset market, bankruptcies and the widespread of corruptions in those markets, like FTX, which we all know, Three Arrow Capital, and many more, which a lot of you probably can name it out. Corp Fin wanted to release the sample letter just to help companies basically comply with your typical disclosure obligations, right, under the federal securities law. So the sample letter is quite lengthy. I think it's like 3 to 5 pages somewhere there. It's got a lot of potential questions or comments that companies should consider as they prepare their Q's and K's, right? And especially companies have exposure to direct or indirect, again, to crypto assets and to any crypto companies for which FTX or other disruptions might have impacted them. But the sample letters cover, kind of the 3 broad areas. One is around the description of business section. And within that, a sample question would be, kind of described any direct or indirect impacts as a result of some of these recent bankruptcy crypto asset participants, and any other exposures to other counterparty risks. So that's something to think about. Also, it asks, what steps have company taken to safeguard customers' assets, and what are their policies? So, something to think about. And that's some of that's what's sample questions that's including the sample letter with respect to the description of business section. With respect to the MD&A, the letter, basically provided a few questions around, any excessive, or please describe any excessive redemptions or withdrawals of crypto assets or suspension of such activities. And if so, what, potential impact does it have on your company's financial conditions and liquidity position, which makes sense, right? If you have a run on the bank, you're probably going to be a bit tight on your liquidity. So it also asks if there's any financing arrangement collateralized by crypto assets. So another important factor, another important point. And then in the risk factor section, it's very similar to the first two sections, ask for any direct, indirect risk due to excessive redemptions and withdrawals of crypto assets or other activities. It also asks for any risk of safeguarding of crypto assets, and other risks that the company might be exposed to because of what had happened in the last 3-4 months. So something to think about, and something just to allude to the audience that letter is out there if you want to pull it out and just read it. Again, this is not what the SEC CorpFin has sent out. It's just, this is what they might send out to CFOs of companies. So that's the only highlight I wanted to
a lot of this stuff, and this even goes for like the fair value pieces here. It even goes for a lot of this stuff is kind of common sense, even like SAB 121 in some ways. You mentioned transparency earlier. Like a lot of this stuff is getting better transparency on your statements and just making sort of slightly more common sense decisions that are, very maybe conservative in some cases, but across the board, a lot of these things seem very, very common sense to me for all these things. So good. Okay, that's really, really interesting. Funny little part of the world that I'm not sure we spend too much time thinking about sample letters from the SEC. At least I personally hope to never to not to spend much time in my life thinking about them for sure. Last thing, and then we'll spend the last 10 minutes on Q&A. But maybe I'll start with William on this one. Anything you would like to see from the regulators over there? When the FASB decisions finally come out, but then just in general from the regulators, from the SEC, from anybody. Anything you'd like to see from folks?
No, nothing specific from regulators. I think in general, this is a point that I meant to get across earlier. Just industry-wide education, I think, is something that is really needed around accounting for crypto assets. It is a difficult task to do manually. We have quite a few clients who come in who utilize Excel or a ledger to try to track their cost basis, their gains or losses, impairments, and it's just almost impossible to do. So one thing I do hope that the regulators and considering new guidance and rules is to understand and have some patience, because there is a tremendous education, and it's very difficult for many to get experience in this industry as well, right? So it's going to take some time. I know at Bitwave we take very seriously our role in educating. Next month we have a series, Crypto 101, for bookkeepers, accountants, technical accountants, auditors, if they're interested. And it's really to just go through how to account for crypto assets, digital assets, and it's we'll walk you through how to use the Bitwave software, but it's really kind of accounting 101 for accounting for digital assets. So it's a good way to gain some experience there.
We do take our I don't know, obligation maybe is not the right word, but I spend a lot of time thinking about training people on how this stuff works. So it is an important part of our role at Bitwave, is to actually train people up on this stuff. Mark, how about you, buddy? What do you want to see from regulators, standard setters, anybody out there?
Yeah, no, thanks. I think what's important is that they, and again, I'll repeat this because I think it's good that directionally the regulators are listening and the FASB standard setters are listening that to the industry and understand there's the need for more rules and guidance so that, as we pointed out earlier, it it helps establish consistency, it helps establish transparency. It has a common set of books, if you want to call it a set of rules for all of us to go to ensure that all reports are consistent and how we do things are consistent. So I think what I'd like to see basically is continue to, for the regulars and for the standard setters just to continue to keep their eyes on the industry and continue to evolve, as fast as we can, I guess, right? I mean, we can only move it at certain speed here, but just continue to do that. And I think having, the last quarters and what's came out is great. And I'd love to see the exposure draft soon. And hopefully that comes through Q1, depending on, Q2, maybe, I don't know, I can't forecast. And I'm not speaking for the FASB or anything like that, but whenever it comes out, I look forward to see what's in there. And I'm excited. So hopefully the rest of you all are just as excited as I am.
I totally agree with you, Mark, and I won't put words in your mouth, but the way I interpret what you said, the way it occurred to me was, there was a very long period where I think a lot of the standard setting bodies just kind of hoped all this would go away. They're like, it'd be great if crypto just died, where we don't have to really worry about this. It would be a funny little experiment in history, and we'd all move on with our lives. That would have been great. But then, what's happened is it obviously didn't. We're 13 years into it. And it's finally that point where like you just, the standard bodies, the different groups out there, they can no longer kind of hope that it goes away. Like we really do need that guidance. And so I'm right there with you, which is my ask for everybody is just to keep on issuing guidance and coming out with this stuff. It's not bad. It's good, in fact, for the industry. And it's good for the SEC to be doing this stuff for exchanges. I mean, there's all these things are sort of net good for the industry, in my opinion, obviously. All right, we have some great questions to finish off here. There's some of these are not entirely on topic here, but I'm gonna allow it. So the first thing is the first question we got, which is kind of interesting, is are DAOs covered by this new guidance? Do either of you want to opine quickly on the impact of DAOs?
I don't know, to be honest. So
Yeah.
I think we have to see if they scope that in or scope that out. I think it's really important. Just when you get the exposure draft, is cover first open the first couple of pages and look for the scope exception or the scope paragraph and see what gets scoped in. So yeah, at least my answer is I don't know. So
yeah, I'll just say this. The definition I kind of covered and the scope was pretty broad. I have no indication of which crypto assets are within scope and without, besides the definition. But I do believe, just looking at the definition, it is trying to encompass a large swath of crypto assets, right? It's not trying to target, a very specific use case or type of token. So I would just say that we have to wait and see for the official kind of exposure draft and guidance there. But I will be interested to see if DAOs are called out as well.
I will say that we've been seen as a trend. We deal at this point we have, I don't know, a number of DAO customers. We have very few DAO customers that are what I would say that do not have some form of traditional corporate entity around them. Could be an LLC, could be an LLP, could be a Wyoming DAO. Like there's a lot of different flavors for this. We talk about this a lot, but there was the BSX thing that came out where essentially a DAO member of part of a DAO that had no corporate entity, they lost $60 million and he's now suing all the rest of the DAO members in sort of under clauses of a general partnership. I think that will have a very chilling effect on not having some sort of corporate structure around DAOs, which then essentially says once you have a corporate structure, then you probably are falling under some of these rules. At least I'm sure they'll clarify which different corporate structures these do fall under, but you probably will end up falling under some of these. It is a super interesting question here. There's another question here, which I think is it's top of mind for some people. What about impairment on mining equipment due to the drastic drop in value? I'm not sure impairment's the right term there, whether it be like an accelerated depreciation or some other form here, because this is getting a little bit away from FASB guidance and things like that, but it is an interesting question. Like, mining has taken a huge hit over the last 2 months. Anything you guys can share interesting about like what they would, how miners would deal with their inventory of miners?
I'll just start. I'll say, I haven't seen any guidance, right, from FASB or other entities on this, but it is an interesting question. In this industry, it can be quite volatile, right? So the likelihood of an impairment to mining assets is quite high, especially in this environment. And I'd say the best, course advice I always give is speak to consultants, your auditors, your experts within your industry to kind of determine how market conditions have impacted your business, because it is very likely in this current environment, not just for miners, but in general, that there have been impairments to assets.
Yeah, no, I'm in line with William. I would only just suggest you talk to your advisor, but I think that's something to think about is, when you talk to your advisor, understand how you originally accounted for the mining equipment. In other words, what accounting model were your mining equipment accounted for under? Is it accounted for like similar to fixed assets? Or did you account it for something similar to another accounting model? I think understanding that with your advisor would be first and forefront. And then, and if that, if you're going back to the original accounting for fixed asset, that's pretty straightforward fixed asset accounting, right? You got depreciation, which Pat mentioned, and you got potentially impairment charges to the extent that that charges are not other than due to depreciation, right? So it's hard to say, but currently, as William said, the conclusions reached does not cover mining equipment, and so you just have to talk to whoever advisors you work with, just understand and work with them on that, and I think that's your first start.
Yeah. Last couple of things we'll show, because we just got a question about it. So this is a quick plug. Bitwave, we have a conference that we do in Austin in April. It's right by Consensus. For anybody that's going to be a Consensus, it's actually the day before. It's called the Enterprise Digital Asset Summit. You can go to edas.live or Google Enterprise Digital Asset Summit to learn more about it. We'll all be there. It'll be a super fun time. It's just a great time to get together with. If you enjoyed this kind of content, it will be a full day of this type of content. And then I thought I'd throw this up there for the someone asked about the Crypto 101 podcast. So I'll drop this slide. I'll drop this into the chat also. But this is the webinar that we're going to be doing on the Crypto 101 for anyone that is interested. Mark, William, this was spectacular. This was really, really insightful. I feel like I learned a lot. I always feel like I learned a lot when I get on the call with you guys. So even I feel like I learned some interesting things today about for instance, mining equipment. I hadn't spent much time thinking about it, about different models for it, to be quite honest. Thank you so much, you guys. Really, really appreciate your time today. Everybody who came, thank you so much. It has been wonderful to have you on here. Amazing questions. I'm sorry we couldn't get to all of them. There were so many good questions here. But this was a joy. Thank you guys so much, and thank you, everybody.
Thank you.
Thanks, Ray. Have a great rest of your day.
All right. Enjoy your Tuesday, everybody.
Thanks, everyone. Bye-bye.